All right. Welcome back. My name's Peter Lehrman. I'm the founder and the CEO of Axial. We have been mostly convening 10 to 12 members of Axial over the last 3 to 4 months in a roundtable setting, just talking about everything in the deal-making world, particularly in the lower middle market, really as it pertains to a new deal-making environment. A lot of focus on COVID, how to manage through it, how to make deals happen, in the midst of it. I'm really excited to mix up our format today and to introduce Tarrus Richardson, a member of Axial who runs an independent private equity sponsor, IMB Partners, out of Bethesda, Maryland. One of the main reasons I wanted to try and get a hold of Tarrus is because he's one of the first Axial members that we know of who has been closing transactions during this period. Most recently closed a new platform. There's been a lot of add-on activity over the last few months, but a lot less platform activity. And it's been hard actually to track him down because I think he's got another couple businesses under letter of intent for a close in the next 30 to 60 days. So Tarrus, delighted to have you join me for a little time today. Looking forward to having a great conversation with you. Thanks for making time, and look forward to diving in.
Awesome. Very nice to meet you. Thanks for having me, Peter.
So lots to talk about. Why don't we just get started hearing a little bit about the firm that you have set up? When we were doing a little bit of pre-show prep, you told me that one of the things that's really important to you is building a real company at IMB and not just sort of a deal-making operation. So tell us a little bit about you. Tell us a little bit about the organization that you have built and that you are building, and we'll go from there.
Sounds great. Sure, let me go 2 steps back and then go forward to IMB. So originally from Chicago, went to Purdue, studied accounting, started clipping articles on people in private equity, and a guy named Reginald Lewis while I was in high school, who was one of the early African-American private equity folks. And it led me to an aspiration to get to Wall Street and get to what we call private equity now. I had an opportunity to go to the merger and acquisition group at Salomon Brothers as an analyst. At the end of my 2 years, I went to Ghana, where me and another analyst from Salomon Brothers helped start an investment bank called Gold Coast Securities that's still around, but traded basically on the Ghana Stock Exchange and did some, call it direct investing in basically Accra in West Africa. And it was that bite of combining sort of smaller market entrepreneurship and seeing opportunities and trying to replicate that got me super focused on trying to be an entrepreneur inside of the world of private equity. Went to Harvard Business School, graduated in '96, was a part of this organization called the Robert Twigel Foundation that basically tried to help get more diversity into financial services, into private equity. And through that program, I got access to a number of private equity firms and summered at a firm called Joseph Littlejohn and Levy, which is now JLL Partners. Received an offer at the end of that summer and started full-time in '96 with JLL. And their investment thesis was sort of 50 to 300 million of equity capital in mostly either restructurings, turnarounds, or buy and build opportunities. I spent 2 years there with this goal of trying to have my own entrepreneurial private equity firm within 3 years out of business school. Michael Porter called and his organization sort of 2 years into that, looking for a professional to help them start a private equity business, which became ICV, or Inner City Ventures, back in '98. And so I was the first employee of that entity. It was partnered with American Securities, which was a 25% anchor investor. And then we hired a guy who became my boss named Willie Woods. And so the two of us were the general partners. We had 51% ownership, and we had 2 institutional partners in American Securities and Michael Porter's nonprofit, the Inner City for a Competitive, the Initiative for a Competitive Inner City, ICIC. So we went out and we raised $130 million in 2000, another $300 million in 2006. And the goal was to write checks of $5 to $30 million into businesses with $5 to $15 million of equity value. We, the management team, Willie and I, pushed hard to include not just inner city businesses, but minority and women-owned businesses in the focus that we had. And over the course of the 12 years I was there, we made 10 platform investments. We generated 20% returns. But we didn't get any minority certified business investment activity going. And what we found was it was a complex market where a lot of people shied away from MBE certified or certified businesses. The large customers wanted diverse companies, but private equity is set up to basically buy and sell in a 5-year window. And so as soon as you were to buy and convert or to support an MBE and make it bigger, if you were then to sell it, in year 5, that spend would be lost. And so the customers didn't like it. The investors felt there'd be a discount on exit. And so it made it hard for us to pursue that investment thesis. So long story short, in 2010, when I was leaving ICV, I decided to open up a business called IMB Partners, which stands for Investors in Minority Business. And the core thesis was that there is a business model out there where working with complex certification opportunities, whether it be service disabled, hubs-owned, veteran-owned, minority-owned, woman-owned, is a place where there's contracting opportunities, there's stickiness of customer, and there's maybe an ability to sort of do something that makes the world better. But it's unique. And so we started out first as a consulting operation where we got hired by Ernst & Young and some other corporations to basically review their supplier diversity programs, talk to their vendors and their contracting officers to figure out what could we do to grow the diversity spend and to better match and reflect their marketplace, their communities, etc. And so within the first 3 years, one of the biggest opportunities we saw was basically in the employee benefit space or insurance space. There didn't exist any women or minority contracting businesses of any scale. And so we pursued that opportunity. We have a $400 million business, $400 or $500 million business that literally does employee benefits, service provision. We help companies make sure that they have transparency, they have accounting overlap, they have standardization. And in the process, we save companies tens of millions of dollars in just making sure they don't overpay on their insurance benefits with large carriers. So that was how we got to our first business opportunity. We'll talk more about the other things we've done, but we've bought 4 other platform companies, and they all have some theme of how do you focus on a sector where there's a business opportunity, there's embedded growth in that category, there's a limited base of diverse suppliers, and with our expertise in just building businesses and depth of focus in our areas of concentration, we can add value and build businesses we're happy with. So that's a long answer. Let me pause. But my background is deep history in private equity, now super focused on not buying and selling businesses, but building larger scale businesses we can be proud of, ideally that become billion-dollar businesses in a couple verticals. You're on mute.
Great to hear the longer arc of the story. Thanks, Tarrus. I think let's dive in a little bit. I mean, obviously minority-owned businesses is part of the expertise and it's part of the DNA of the company, but that's really only one, I guess, one arrow in your quiver. Right now, it seems that you guys have gotten well past the point of your feet wet in a couple of specific industry sectors. Talk a little bit about where IMB is focused. You know, everybody in private equity these days is trying to figure out where to be specialized, whether or not to be specialized, how much specialization is gonna be appropriate and correct. But you know, everybody's looking to develop angles on businesses because being a generalist is you know, at least for the moment, considered a tough way to win deals. So let's hear about the platforms that you have and how those have begun to shape a real specialization for IMB that goes way beyond, minority-owned businesses and cover some really significant industry category ground.
Yeah, that's a great segue, Peter. For us, we started out as a generalist firm thinking that there's many ways to win, but with a certification strategy, at a minimum, we were B2B or B2G because we thought those are the contracting arms that are going to care about diversity certification. And then we tried to figure out, okay, where does it really help you win and where does it not necessarily add any additional value? And over the last nearly 10 years, where we evolved to is companies that have some touch on regulated industry. So whether it's pharma, whether it's what became our focus is, right now we're focused on electric and gas utilities and government contracting. And how we got there was basically in electric and gas utilities. Every year there's a utility commission that sets the rates for both the price that an electric company can charge as well as what their capital spend budget will be. And if you get to certain states, they're going to ask that utility to report on their impact on community and support of a diverse supplier base. And just that accountability on an annual basis results in those utilities wanting to do their very best. And so we got to that space in 2015. We ran into a woman who had started as a second-grade teacher. She built a $200-300 million business with 40-plus million of EBITDA. And we're like, wow, that really is something that we would like to do. And we saw the power of her woman certification pulling her along. A few years after that, in 2018, we bought a utility contracting business called LaFata Contract Services out of King of Prussia, PA. We had talked to a number of people who said, hey, diversity would matter there. But ultimately, the core thesis of what we've learned is simply you got to start with a proven operator who has success with the existing customer. How we differentiate as a firm is we take customer concentration, which other private equity firms don't. And so usually it leaves a smaller buyer universe that we can compete against. And most private equity firms think, hey, if you buy customer concentration, your job is to quickly go and try to get other customers with that embedded customer or a company that you buy. And with an MBE strategy, you basically want to double down. You want to go to the customers and say, look, we're a quality contractor. We're going to add capital. We're going to hire more people. We're willing to follow you to additional markets as a vendor to you or a contractor to you. If we bid more, can we win more? And that's what we found at LaFata. We have probably a 95% success rate on bidding on new opportunities. We went from a Philly-based company to expanding to Baltimore. We hired a very seasoned, 30-year person from Baltimore Gas and Electric. We opened an office. We committed to best practice of hiring employees, and we basically have, doubled EBITDA in less than 24 months by staying within the Exelon family of companies, growing through excellence of hiring people and building a business. And the MBE has been one of the things that's helped us, at least in ties on RFPs, to win a few more. So in electric and gas, that's where we're focused. We want to mitigate customer concentration through acquisitions of additional utility contractors. And we should show up, in 3 years with a $50 to $75 million EBITDA business in some version of construction, professional management, project management, servicing electric and gas utilities. So long story short, one of our focuses is electric and gas, and then the other is on government contractors. Similar thesis, deep specialization on understanding how government contracting works. A lot of people shy away from investing in government contractors on the private equity side, because there's these rules, there's these contracts, there's this uncertainty, and typically a lot of customer concentration. We've done well by it. We've made 3 platform investments with government contractors. We think we'll build a $100 million EBITDA business in that sector as well.
So let's talk a little bit about like the customer concentration aspect of this. I mean, there's obviously the MBE side of this, but you guys have clearly taken a contrarian point of view on customer concentration, which, you know, definitely scares away a lot of buyers that otherwise might compete for a given asset. So one of the things that I was curious about is when you guys buy a business and are going to, you know, capitalize the business better, potentially bring in additional operating expertise, and, you know, how publicly are you sharing that information with your clients? Like, so in the case of Exelon, for example, sounds like the way that you wanted to go about, you know, managing customer concentration wasn't necessarily to add net new customer logos. It was about going deeper and bidding on more contracts with the existing customer base. Once you've acquired a business, do you actually indicate to, you know, to the existing clients, hey, IMB Partners has now decided to back this business. We have the following expertise and capabilities. You know, how public are you about indicating that IMB has actually become the owner and the operator of the business? A lot of times you hear about sort of private equity firms quietly buying businesses, you know, no financial terms disclosed, you know, no press release, you know, barely even a whisper to employees, maybe sometimes. Sounds like you're taking a really different approach as part of how you go out and compete to win new business and new contracts. So I'd just love to hear about how you guys, you know, introduce IMB to the customer base.
Yeah. So publicity is a tricky place where we just want to be about it, not talk about it, right? So we've not overinvested in public awareness, so to speak, of our activity, but we have doubled down on communication with inside a company. So with Exelon, we reached out to board members, we reached out to the supplier diversity heads within Exelon. The company we bought had really been a bottoms-up company that had lots of contracting with specific contract managers in capital spend for electric projects or gas projects, but it really never had CEO conversations or chief operating officer conversations on an annual or semi-annual basis. And so we asked for category review conversations top down. We don't think smaller contractors do that. Neither do we think diverse minority contractors do it. They granted us those meetings. We shared our business. We told our vision. And we shared that we would roadmap of where your spend will be and what you're trying to accomplish. We'll try to match the business plan to yours. We want to be a better partner. And so we're basically lifting out a construction manager, building a construction business because the business units we work for at Exelon are doubling their capital spend in the next 5 years on an annual basis from $400 to $1 billion a year. They need more construction contractors. We're going to supply one for them. So as we go top down and make sure they're aware. 2 is we got to hire more people. Most small businesses are not overstaffed. They're understaffed. They tend to under-hire. So most people will hire a $200,000 person as an entrepreneurial firm. We may hire a $400,000 person that may be more expensive than the CEO at the company, but they have embedded relationships and know-how with the end customers or the end contractors in a way that makes us better, faster, and more efficient over time. And so we go straight at it and talk to them about how do we build a better business that matches against their growth strategy. And for the customer concentration, like in the case of the business we bought, we're going to go from 2 to 8 million of EBITDA in less than 5 years, organically, all within mostly one customer maybe different platforms in that customer. And our goal is to then, around it, make additional acquisition of utility businesses, sister companies, or add-on, where we'll get another 20 to 30 million of EBITDA via acquisition. So you add it all together, we'll have mitigated concentration through acquisitions, and we'll have created a lot of value through organic growth with the incumbent.
And do you, we haven't talked about government contracting yet, but is this generally, does this playbook sort of translate to government contracting more or less as well? Tell us a little bit about that.
Yes, and government contracting has, different flavors to it. So a lot of contractors go to market as small business, as women, as service disabled, et cetera. And ultimately, if you're going to try to build a big government contractor, you have to be able to graduate to basically being a open and full and open contracting large-scale business, and then have the understanding of how to do teaming arrangements with these subcategories of small business and hub zone and veteran and 8A. And so our secret sauce there is not being the minority contractor or being the woman-owned contractor. It's understanding what that contracting officer is faced with and challenged to try to deliver in terms of small business and the various subcategories of it, and then showing up with a partnership or a teaming arrangement with our vendor partners in a way that we can help them deliver their goods and services, but also introduce teaming partners that enable us to hit check marks and boxes along the way. And so if we get that right, we become a couple $100 million, $1 billion business in, for us, very dedicated areas. So we think cyber and IT is very safe, mission critical. We think military contracting and feeding are very critical, and we like to build two businesses in those two areas that, add value to the end customer, add value to our government, but help them both check the boxes on, their various categories of socioeconomic business consideration, but also deliver best price, value, and service.
You mentioned, I guess maybe 10 minutes ago, one of the challenges associated with what you all have figured out how to do with a lot of these businesses is as you pull out different pieces of the playbook, if at the end of the day, whether it's year 3, year 5, year whatever, you end up selling the business, you run into, you sort of unwind a whole bunch of what you've achieved, whether, not just from an acquisition and customer concentration perspective, that's probably valued by any end market buyer, but a lot of the work associated with MBE, a lot of the expertise around that can kind of go out the window once the business is swallowed up by a strategic. So that's changed the way you think about producing liquidity for yourself, producing liquidity for your investors. That might be one of the reasons why you've continued to stay as an independent private equity sponsor, just because of the flexibility that it offers. But I'd love to just hear a little bit about how you think about hold profile, how you want to differentiate based upon that, because a lot of times, it's not just about what you're doing with the business, it's about whether or not you plan to hold the business, how long you plan to hold it. A lot of that influences the way an entrepreneur thinks about who they want to sell their business to. It's not just about what you're going to do with it. It's also about whether you're planning on holding it for 3 years and then selling it, or whether you're planning on holding it maybe indefinitely. So love to hear a little bit about how you think about hold profile.
Yeah. So it's a couple ways that we come at it. One is, there's this book a couple years back called The One Thing that talked about spending 80% of your time on things that are, on the one thing that's most important to you, et cetera. So it pushed me and pushed us to try to start focusing, right? And we came up with electric and gas utilities and government contracting as a way to reduce our footprint to areas where we could be subject matter experts over time and start getting luckier. And so there's a quote that says, the harder you work, the luckier you get. The longer you work, the luckier you get. The more focused you are, the luckier you get. Because as much as you're eliminating other opportunities, when you find good businesses and you find opportunities in these areas that you're spending all your time in, you're just faster at seeing the opportunity, clear on what your playbook is to help add value. And it becomes a question, well, if you know you can generate, sort of above market growth rates and EBITDA growth rates, et cetera, why would you want to exit businesses that you love? And, having been in the traditional private business for, 14, 15 years before starting IMB, it was clear that the whole business model of traditional private asset equity is basically asset gathering, right? So you buy and sell to create liquidity for yourself in return, and then you market that to raise a fund that's 50 to 100% or more greater than what you had, and then you show up with $1 billion, $2 billion, $5 billion under management, and that's how you create value. That model is tried, tested, and successful. There's no question about that. But as an individual private equity operator, the question is, who do you want to be and why are you doing what you do? For me, I want to build purpose-driven businesses that I can be proud of, that we believe help create better businesses for our end customers while also putting in diversity and inclusion and sort of community outreach efforts that match the values of our customer and who we want to be. And, the long-term hold philosophy of our firm is simply we want to hold things for 10 or more years. And I'm 50, and so if I can hold a business for 20 years, I'm going to be happy to do it. And then the question is, okay, well, how do you get people in and out? So when we talk to founders of businesses that we buy or our investors, we say, look, we want you to, cash out, 60, 70% rollover, the balance in the company that we acquire with you, get a second bite of the apple in 5 years. What that means is we will go to market 5 years, every 3 to 5 years with some version of a recapitalization, and we'll either take off a partial return of our money, we'll take out investors who want to get out fully, but we, IMB, or we, the principals, will continue to own and operate the business almost as if we were a founder management team or a long-term permanent management team. And what that does is it creates liquidity, but it also creates certainty over the initial process of building out a more valuable business. I think our long-term vision is simply when you get the scale, 25 plus of EBITDA, 50 of EBITDA in any one of our sectors, that you're so mission critical to your customers that whether you lose the MBE or keep the MBE, you're going to be fine from a valuation standpoint. But more importantly, you have ways to get out. The best company in the utility space is a company called Mastech. It's $8 billion of revenue, $1 billion of EBITDA. A Hispanic firm owns it. It's publicly traded, and it still has a, quote, minority certification that adds value. So you can get out through a public offering. You can get out through the secondary private offerings, and you can just hold it. So we intend to build long-term businesses 10-plus years.
When you think about purpose-driven, I mean, let's dive into that. I mean, that's something that's important to you. I think it was there day one as part of IMB. Sounds like it was actually there as part of, your prior firm. It was a big part of what you and Michael Porter cooked up when you were at HBS. So what does purpose-driven mean to you? How is it manifesting in the businesses that you're owning and operating?
Yeah, it's a lot of cuts at it, and I think in the most simplest way, every one of us has to be able to say when they're 80, 90 years old, did you do what you tried to do, and did you use your tools and your talents to the best of your ability, right? And so if you take it at that most simple level, I'm simply trying to feel like I have done what I could do to help build businesses that we could be proud of, that create wealth for employees and owners, that help to connect to communities and to its customers in a way that adds value and that reflects the diversity of our country, right? And so, and then on the micro level, we have to be honest and say access to capital for minority entrepreneurs and minority businesses is limited. And so rather than talking about the complaints of it, going in the market and trying to give people actionable opportunities to finance and to help build is a way to sort of break through the issue and to demystify the process of raising capital. We'll talk about it, but we've been in the market. We probably talked to 100 plus financing sources in the last 90 days and probably had 95 no's. And so on one side you could say it's a problem, but all you need is 5 yeses to get things done. And so, yeah, you may have to work harder to get lucky, but the capital is there. The talent in terms of diverse teams, a lot of the businesses we buy don't start out as super diverse. And so we take it upon ourselves to try to add a diversity lens to the recruitment process on a go-forward basis to diversify senior management over time. We invest heavily in sort of, community and workforce development training programs inside, but really outside, supporting established things that are already in process to help diversify the workforce in the sort of junior to mid-level management. And we all just try to, every day that we can, to be a part of a broader ecosystem that's helping to build businesses that matter.
Who do you feel is the key agent in sort of executing the purpose-driven framework within the businesses, particularly when you're buying a business and getting behind a business that doesn't have a lot of roots or a lot of ancestral DNA around diversity? How are you getting that wheel set in motion? Is that something that, are you getting aligned on that with the current business owner or the current CEO of the business before transacting? I mean, just how does it actually take shape? How do you start to turn a wheel that hasn't been actively turned before?
Yeah, slowly. We start with a very basic concept that says the day before and the day after we transact with you, we want you to feel like the business is the same, right? Because the place where we've had the most success is making sure that our partners are our friends 20 years later and that they trust us, they believe in what we're doing, et cetera. And so the easiest way to gain trust with owners and management teams is simply to do what you say you're going to do and to make money, right, to build a better business. And so some places the opportunity is so real that it's a part of the key business objectives because it helps us win contracts. And so when that's the case, you have more latitude to come in with more stuff immediately.
Yeah.
And so we would want to believe, so my firm has a diversity and inclusion policy. All of our businesses have a diversity and inclusion policy. It includes intentionality around recruiting and hiring, intentionality around supplier diversity, intentionality around how we support community efforts, et cetera. But it's not a one-size-fits-all. In some businesses, they don't come ready to go, and so you go slower and they come more ready to go. And so we take it at the pace that's needed, but we have sort of a 5-year, 10-year goal to say we're going to get to a business that has more diversity and inclusion, and we're going to get there in a way where it wasn't, we're not hitting someone over the head. We're just showing them how 1 + 1 hopefully equals 4 or 5. But we give them best practices, we give them frameworks, we give them our other portfolio companies to use as samples in a way where they can see it. One thing we haven't talked about is in our toolkit is this thing called the Entrepreneurial Operating System, or Traction. It's a business strategic planning and operating system that a equity firm owns this business called Traction that was founded by a guy named Gino Wickman. At this point, we've implemented it across IMB and all of our portfolio companies. It helps everybody to understand what your 5-year goals are, 3-year goals, 1-year goals, what your 90-day, sort of 3 to 7 most important initiatives are. And what's been invaluable about it for us, which has been implemented over the last 12 to 16 months throughout our companies, is the secretary can explain where we're headed and what matters to us at any one of our companies. And as everyone starts to understand what the vision is and why we exist and what we're trying to work towards, it becomes easier for us to put in place this value system around inclusion, because it's one of the things that everyone's talking about in a way that is safe but also clear on what the objectives are for what good looks like.
Yeah, no, I'm familiar with the EOS framework. There's a couple of other, I think, similar frameworks, and it's interesting. I don't hear too much about EOS or the scaling up framework from Gazelles. I don't tend to hear about them too much in the world of private equity, but they're great tool sets. I'm surprised that they don't have more acceptance and more visibility within sort of private equity post-transaction, operating plans. They've been very effective for a lot of small businesses.
Yeah, I think, we're hitting the ball out the park, and in terms of, what our goals were for 2020, what our goals were for acquisitions, for asset gathering. And, we've been pushed to hire more people, the whole get the right people in the right seats and stuff like that, all because it's forcing us to not only hire for today, but hire for where we're trying to go, in a way that, in the middle of COVID, where things went remote, we were so piped in on what our goals were. EOS has an online software across all of our companies where we got KPI, our metrics against our goals, that it just was a very seamless transition to online. So we do think sort of having standardization around, what your playbook is and how you work with companies is helpful. And it's super helpful when you're trying to manage, a variety of platforms.
Right. Well, let's talk about the current, sort of deal-making environment. I mean, the best way to do that is just to get into the specifics. You announced the acquisition of Ashburn Consulting not even a month ago, right? And that was kind of how you and I got on one another's radar. That was a business that you sourced through the Axial platform initially. Do you remember when you sourced that? Do you remember what month that was?
So we probably saw the business in December, January. We took our first meeting in person in January, and then, we may have had one more. We had 2 meetings with management, and then COVID happened. And so by the time we got into LOI and into the fundraising process or the QV process, it was all by Zoom. And so the lender had never met the management team or us, for that matter, but we were able to get it done by Zoom. Yeah,
let's hear more about that. I mean, I haven't heard of too many lenders that are doing that kind of deal. I'm sure that was one of the things that you had to overcome. When you were talking earlier about talking to 95 or 100 financing sources and only having 5 say yes, were you referring to the financing process for Ashburn, or were you thinking about and talking about some of the other transactions where you've been refinancing businesses, or both?
Yeah, so I mean, we came out of 2019 with this goal of deploying 25 to 50 of equity capital. We were all piped in and focused. We've hired 4 additional people onto the team through February, and by the time we got to the end of February, we were under letter on 3 companies to purchase, and we were contemplating refinancing, our. And so At this point, we've been in market with 4 financings and 3 acquisitions. We've completed the refinancing of E&E. We completed the purchase of Ashburn, and we hope to buy 2 additional businesses in the utility space by the end of September. So we're in the market on 4 different financings and, quite frankly, over 100 touch points with lending partners or equity partners at this point.
Are the 2 businesses that you're under letter of that have an early fall potential closing timeline, were those pre-COVID source transactions, or have those happened after COVID?
Everything has been pre-COVID and would have closed in the summer and has stretched a little.
Yeah.
So Ashburn was on track to close in May. It closed, July 10th or whatever it may be. These utility deals were on track to close in July and are now on track to close in September. So there has been just things move slower in this process. But, our deal volume primarily shut down second quarter. Like, the number of new deal opportunities that we saw that we thought were interesting to pursue, has really collapsed. And so what we have done is 2 things. We have decided to gang tackle the things that we are doing to make, we are over-focusing on trying to close on things we want. We happen to be in 3 areas, cyber IT for government, electric and gas utilities, and basically the grocery business and military. All of them are mission critical and have had the ability to sort of hit the crisis, come out of the crisis, and now be in a position to be on offense.
Yeah.
And everything we're trying to acquire are in those verticals, and so they are mission critical as well. So we didn't need to reprice the things we were trying to acquire. Everything credit tightened, and so we're putting more equity in the businesses because credit reads are tighter. But they're still businesses we want to own. And then on a go-forward basis, instead of waiting for auctions, we now are proactively calling businesses that we know we want to own or that we know are in year 4 through 6 of a hold in a private equity firm, and basically trying to create our own opportunities. And so there's a few things that may come out of that in the next few months. But it's, I think, the most incredible, sort of private equity market I'm going to see in my career, because it's a lot of people playing scared, a lot of people, dealing with crisis, a lot of people in long holes that were planning to get out. And if you can be on an offensive footing, it's an amazing moment in time.
Yeah, I was going to ask, how do you think about the fact that you happen to be in 3 of the most resilient sort of business categories? How much do you attribute that to skill, to luck? It's obviously a great place to be right now, but it's a place that you've been long before COVID. How do you deconstruct how that all happened? Is that luck or skill? What kind of combination of the 2 is that you happen to be in 3 very, very resilient mission critical categories?
It's, look, I had never heard of mission critical, right? It was all, you were focused on downside risk, right? So we, as a firm, always have learned to underwrite for credit and get lucky in terms of, the equity opportunity. And so if we're going to take customer concentration, which is our thesis, we needed to be in sectors where you had subject matter expertise that meant the customer was unlikely to discontinue you, right? And so it pushes you to a certain place. Once you're doing business to business, we used to be at ICV, we bought food suppliers to, that had more of an approach to restaurants and to other places where there's more discontinuation and more risk. But in a customer concentration and in a world where in the last, 4 years we've had this prolonged sort of growth cycle, every underwriting we did said, how do we think about downside risk? How do we think about a recession? And it just pushed us to places where we thought in 2008 to 2010, which sectors did well in that downturn. And infrastructure was one of them. Our IT businesses have been one of them. And I've been in the food business since 2001 in military, and it did well. And so we got there by basically prior experience and thinking about what happened in 2008 to 10. But we weren't using the word mission critical the way we now use it because of COVID. So to say we nailed that would be an overstatement, but we happen to be in the lanes that we're moving upwards.
Well, we've got a few minutes left. I want to make sure I don't chew up your whole morning, Tarrus. I know you got a lot of work to do, a lot of stuff that you're running down. Couple things, our audience at Axial, in terms of who listens to conversations and tunes in for our events, it's a mix of professional deal makers in the trade, buying and selling lower middle market businesses, but we serve a lot of entrepreneurs as well. A lot of entrepreneurs passively subscribe to our events, media, to our blog and online publications. Let's maybe finish with just a couple thoughts on maybe a couple thoughts on a lightning round of questions with respect to entrepreneurs. I want to touch on Q of E in particular, because you and I had talked about it, just getting ready for our conversation today. You said the other day, maybe the single best use of time and money for an entrepreneur who's thinking about being exit ready, transaction ready, is having already done what you refer to as a sell side Q of E, either on their own or in partnership with maybe an investment banker that they've already hired. Can you just explain what you're thinking there and why you feel that way?
Sure.
And feel free to just sort of take it all the way from the top. What is Q of E? Why does it matter to you? And then talk a little bit about why you think it's such a good use of time.
So most entrepreneurs typically don't have to invest in third-party audits. They mostly spend their money on tax work to just figure out what they have to pay the government at the end of each year. And so they'll come to a sell process with reviewed financials most of the time and good tax work. But at the end of the day, there was never a focus on what monthly financials were, quarterly financials, or audits, because they were only reporting to themselves, right? And so they show up with financial results plus some adjustments to try to take out things that may have been more quirky to how they expense things for tax purposes or just for how they allocated expenses. And what they want is certainty of close, speed of close, and clarity of what the deal is. And what the investment banker wants is to close, and what the buyer wants is to close. But without having sort of a third-party audit on financials, it becomes a gating item. And in our own business, when we were selling businesses at ICV, my former firm, here I don't sell as much, but we hired a buy-side, or we hired a sell-side when we went to market to sell businesses, just to create a level playing field on here's what a third-party accounting firm thinks of. A quality of earnings is basically a proxy for an audit, but with more of a lens towards selling your business and explaining the adjustments to get to EBITDA and to explain what your working capital needs are, current assets minus current liabilities, et cetera. And so the more that can get done early, the faster everyone can be on the same playing field of what the company's true EBITDA is. And yes, the buyer still is going to elect to either hire their own Q of E firm or to be able to direct the Q of E firm that you've already And so there is incremental cost, but it just speeds that process up, and it reduces the risk that you say the business has 5 of EBITDA and the Q of E firm says it's 4. Now you got a valuation problem because people are paying a multiple on EBITDA, and as a seller, you want to know that sooner. And I think a typical firm can get away with a Q of E in the $25,000 to $50,000 range, and whether you do the full boat or you do partial, getting that process started reduces your risk of a busted auction. My first experience with you, Peter, and Axial, we were trying to buy a business, a month into being a Axial. I think Axial's been an exceptional platform for us to see inbound deal flow, and it typically comes unaudited. But it's great businesses, but just need sort of the audit feature to them. And in that case, we got through a Q of E process, and the accounting work didn't support what the entrepreneur was saying his business had, and it ended in we couldn't get the valuation to be in an agreement zone to get a deal done. In the case of Ashburn, which we bought by way of introduction through Axial, there what we did was we agreed to split the cost of the Q of E prior to, going forward in the deal. So it was a $50,000 Q of E. We put up $25,000. They put up $25,000. We shared the scope, and so the accounting firm worked on both of our behalves. And before we moved to financing and to legal and all these other expenses, we spent the first 20 to 25 days finalizing the Q of E. Getting that gating item out of the way enabled the rest of the process to move much faster.
Did you have an LOI in place prior to the Q of E?
We did. So for us, in 90% of the deals we pursue, sub $10 million of EBITDA, we basically say we want to sign an LOI, spend up to 30 days finalizing a Q of E, of which we will put half. If you don't have an audit up front, we think you've underinvested in accounting. And so we want to help you. We want to share the risk. And up to $50,000, we want to put up half, you put up half, and we scope a Q of E that basically gets completed so that the numbers are settled, and now all you're trying to do is the confirmatory due diligence work.
Are the LOIs in those cases where there's no sell side or no pre-existing Q of E, are your LOIs typically submitted in a way that's tethered to the Q of E EBITDA number? In other words, the way the offer is submitted is sort of 6 times EBITDA, Q of E EBITDA. I mean, how do you actually structure the offers, or in a way that tethers to to what you want to get aligned on with the entrepreneur?
So man, we in this world, we are not trying to make the last eighth on a deal. And so if you say you got 5 and you come in at 4.6, okay. You got 5.4, okay. If it's materially 15, 20% different than what you say, we will say we're bidding off a multiple, and we adjust on that multiple. But we're not using it to try to trigger price. We're using it to try to increase certainty. And so the more they get comfortable that, we have the accounting firm to grind them down so we can get a lower price. Like the opportunity we have in the lower middle market is growth. And so, we'll get a price that seems fair. We'll be within a bandwidth of EBITDA that the Q of E sort of settles on. If for some reason they miss something very big in what they presented to us, we'll talk about it. But it's more just to make sure that it's within the bandwidth of what they say they have, if that makes any sense.
Yeah. Well, maybe just one other question. I mean, you mentioned actually when we got started, as you were just introducing yourself, you mentioned one of the important figures in your life was, one of the first, Black operators and entrepreneurs in private equity. Um, could you talk about other just interesting either people or books or sources of inspiration for you that have just been an important part of who you are and the DNA that you've been building into IMB and the businesses? I think so many people that listen and tune in to this kind of content are always interested in hearing, what is the literature, what are the people, who are the interesting people that, that other people that have been successful in private equity, and not Black people specifically, just everybody and anybody that's really shaped the course of a successful trajectory in private equity. It's always interesting to hear what have been the big sources of influence, people, books, or otherwise. Anything else come to mind in addition to Reginald?
Yeah. So look, I come from a family that, my dad was in Vietnam, GED, went to get his associates, and then wanted to start a business, decided to buy a bar when I was 8 years old in a suburb of Chicago. And in the process of buying that bar, I was 8, my brother was 11. In the, quote, acquisition vehicle, both my brother and I were shareholders. And we helped restore the bar, we helped clean the outside of the bar, stock the bar, and, do odd jobs, growing up on top. So we were an entrepreneurial family. 4 years later, we bought a popcorn business. And, so my dad was doing these one-off deals, wasn't starting companies. He was buying an owner out. But these were businesses with $1 million of revenue or whatever it may be. And we were, in that phase of my life, I basically ran into this article on Reginald Lewis, who had bought this $1 billion business. And I was like, that looked like a really good job. And so I got interested in private equity from clipping articles on him, Henry Kravis, and this guy, Erwin Jacobs, when I was in high school.
Sure.
Roll forward to Purdue, I pledged a fraternity, alumni network came back for a homecoming, and a guy named Kelvin Pennington came back, who had been at Prudential Capital and leveraged buyouts, and had started his own private equity firm in '90. I proceeded to call that guy every week for 13 weeks straight. He became a mentor and friend. He advised me through most of my career. He invested in every deal at IMB, became an advisor to IMB, and in January this year, he joined me full-time as my partner. And so to have a 31-year relationship with someone who was 10-plus years more experienced in the business now join our firm, it just is, on that side of it, is mentorship. And then on the other side, in 2011, 2012, we hired a woman named Amber McCants, who I had tried to hire in 2006 from Goldman Sachs. She was looking to leave, wanted to have more purpose, wanted to do more diversity investing. And so we've now worked together 8 years. She's the number 2 person in our firm. She's one of the leading women in private equity. Couldn't be more proud to watch her growth and development. Secondly, we hired a guy that summer, 2011, 2012, named Derek Witherspoon, who was in between first and second year at business school. He interned for us for free. He wanted to get paid, obviously, when he graduated at Carlisle for the last 8 years, has gotten a terrific background training and exposure. He called up last fall saying, I want to, get more into purpose-driven investing and see if there's an opportunity. He joined in February. And so on one side I have, the 31-year mentor, and the other side I have 2 very seasoned, very well-trained, sort of people in Amber and Derek, who are the next generation of leadership for our firm and for the industry. And what we're trying to do is to build a business that both reflects that diverse talent can succeed in this industry, that we can do world-class, sort of execution of a business strategy with our companies. And in the process, we can give a tremendous opportunity to talent to show what they can do. So it's been backwards and forwards. In terms of a book, I would say the book I've read most recently is What It Takes by Stephen Schwartzman. It is, in my opinion, the toolkit for anybody trying to do private equity. The thing that stood out to me and has changed our way of raising capital is, he and Pete Peterson said they went out to over 1,000 people to raise their first fund and got told no, 900 plus times. And I looked in the mirror and said, if Pete Peterson and Steve Schwartzman could get told no that many times, we aren't asking enough people. And so when I talk about getting out to 100 plus people before I talk to 30 and I get fatigued, now I know that my job is to get told no more, because we got to find people that believe in our story and believe in our capabilities. And being told no is not a negative; it's just a part of the process.
I don't think we could end on any better note than that. Just great detail and great color on just things that have really influenced you, and obviously congratulations on adding 2 incredible partners to the IMB organization that clearly put they just make it clear how focused you are on building a company and not just doing one-off deals, which we talked about. So Tarrus, it's great to have 75 minutes with you. I really enjoyed it. I know that folks that want to listen into this kind of content and hear more about the way deals are getting done will really enjoy hearing your story, the IMB story, the aces up your sleeve that you use in order to build more valuable, more successful businesses. It's just been a great conversation. I've really enjoyed it, and I just want to thank you again for carving out time. I know you got a lot going on right now, so thank you so much.
Peter, thank you for the opportunity. Thank you for building Axial. Like I say, it's a tremendous tool for people trying to do business in the lower middle market like IMB. And I can't wait to do more with you, but grateful for the time.
Terrific. Well, I'm going to push the pause button now, and we'll sync up after we push pause. Sit tight for 1 sec. Thanks again, Tarrus.